Good day and welcome to Central Asia Meets Half-Year Results 2021 presentation. I will now hand you over to Nigel Robinson, CEO. Please go ahead, sir.
Well, good morning, everybody, and welcome to Central Asia Metals PLC's 2021 interims presentation. And if we could have the first slide then, please, Georgie. Hello, Georgie. Can we have the first slide, please? Just put up on the screen there. We seem to have a bit of a technical problem, I'm afraid, here at the moment. I was just waiting for the slides to come up on the screen so I can talk to them.
Apologies, the slides are up.
Summary of what we've done in the first 6 months of this year. I'm delighted to announce some really strong financial numbers, as you can see on the page there. So on the back of that strong financial performance, which is driven by strong commodity prices, we're delighted to announce an increase in our dividend to 8 pence for the first half of this year. And we'll also be paying back early $10 million of our corporate debt facility. So $10 million back to the banks and 8 pence, which is $19.5 million back to shareholders, which if we were to pay the similar kind of dividend at the final, that would be a yield of about 6.8%. That's driven off the back of strong revenues. Our revenues increased to $106.3 million from $75.4 million in the comparable period last year. And the EBITDA on the back of that at a 61% margin was $64.4 million. A key number for us is our free cash flow, and that's increased 131% in the 6 months period to $48.9 million from $21.2 million. All of us will remember the first 6 months in 2020, so the comparable period was a particularly tough period for all businesses, but still 131% improvement is a good performance on the back of those strong metal prices. And that's the number, the free cash flow that we pay that dividend against. And we're around the 40% of that number for the 8 pence dividend that we've announced this morning. On the back of those strong cash flows over the period, we are deleveraging the balance sheet. We've now got just under $61 million of gross debt on the books and cash of $54.3 million. Outside of the financial numbers on sustainability issues, we've had a good response to COVID-19. We currently only have about 3 employees at Sasa with COVID-19 and none at Kounrad, and our procedures are proving to be robust to prevent much disruption on site from the pandemic. We have unfortunately suffered 3 LTIs, and I'll talk about those later in the presentation, which gives us an LTIFR at the half year of 2.5. We reported our second sustainability report to GRI standards in April of this year. And one thing which we negotiated one day after the period end on the 1st of July with our electricity supplier in Macedonia was the supply of 94% renewable energy to the site. We have to purchase a percentage from the government, which is claimed to be renewable. So in essence, we're looking at 100% renewable energy at the Sasa mine. And that should reduce our CO2 footprint for the group, not just Sasa, but for the group, by about 35%. We are still working on other projects at Kounrad and also at Sasa to further improve that, and we'll be coming out with targets later in the year as part of our climate change strategy. And last but by no means least, before I hand over to Gavin, the cut and fill project at Sasa is underway. It's progressing well, and we're on track to deliver on that in Q4 of 2022. And on that point, I'll now hand over to Gavin to give some more information on the financial numbers.
Thanks, Nigel. We can turn to slide 4, please, which just gives a background to the market that we operated within through the last half. COVID is still prevalent, unfortunately, and we are seeing sort of varied vaccination programs. So we continue to be sort of wary ourselves, but and operating within this environment. But what that has impacted is metal prices. So you can see in the charts on the right-hand side of the slide, the average prices that we've received for copper, lead, and zinc over the past 3 periods, with appreciable increases in those prices due to sort of squeezed supply, robust demand, given the sort of stimulus that we've seen coming through from governments, And also, the sort of build back better mantra that governments are selling us with the transition to green economy, very supportive of copper prices and also zinc prices led. We did see some supply disruptions throughout the industry, but weak demand from the auto industry due to this semiconductor shortage has capped some of the demand there. Treatment charges we mentioned here because those feed through to our lead and zinc revenues. We did see an increase period on period. That's because those prices sort of kick in from the 1st of April every year, and we do expect them to reduce as of 1st of April this year. And we do continue to see spot TCs being suppressed, mainly due to continuing COVID impacts on supply and sea freights. If we turn to slide 5, please. There's a summary of the income statement. As Nigel mentioned, the highlights there, gross revenue and EBITDA really responding to those increased commodity prices with increases of 41% in the gross revenue line there. And what I'll draw your attention to here is some increase in the cost of sales. Now that does include $14.8 million of depreciation, which we report in that line. And we also have a unrealized hedging loss, which is $4.9 million in that cost of sales as well, which hence we're sort of reporting that adjusted EPS at the bottom of the table there, which strips out that unrealized loss to allow you period-on-period comparable. So you can see the EPS has gone up by almost double. Again, the chart on the bottom right-hand side of the slide probably tells the story best, where we're seeing increases in the commodity prices and their impacts on revenue. You can see that copper alone has contributed to a $20 million increase in revenues, with more modest increases from lead and zinc, but still significant to push up that gross revenue line on the income statement. Margins remain strong across the business, as Nigel said, 61% for the business as a whole, and segmentally we're looking at a EBITDA margin of 80% at Kounrad, which is a stunning result for that operation, and 54% at Sasa, both significantly increased over the prior period. We turn to slide 6, please. We can show you the sort of development of our EBITDA from H1 2020 to H1 2021. Obvious there are the huge increases in commodity prices that we've seen for each of copper, lead, and zinc. And then where we've sort of suffered some losses, we've got a fair value loss on the hedges of $1.9 million. We hedged 30% of our metals for the year, beginning January. And then the other cost of sales, we are seeing some inflationary pressures, which I'll talk to you a little bit more in a later slide. And that G&A cost of $1.9 million is non-cash and relates mainly to share-based payments. We turn to slide, what is this one? 7, I think, yeah. Let's just scribble some notes over there. So, cash costs at Kounrad, as I said, that EBITDA margin of 80% really being driven by extremely low costs. They have increased from 48 cents to 57 cents. This is a consequence of increased electricity prices, primarily increased reagent consumption, and a slight decrease of 393 tons in terms of units produced. So if you look at the dollar amounts at the bottom of the table, you can see almost $1 million increase, which is related to in the C1 costs, related primarily to sort of inflationary pressures and those reagents, which constitutes $0.6 million of that amount. And if we look at the total cost of sales, we are looking at around a 20% higher total cost of sales for Kounrad, but around half of that is actually related to MET, which is the royalty, effectively, which we pay to the government for copper extracted, and that is directly related to the increased copper prices. Switch to slide 8, please. Similar chart for Sasa, the C1 equivalent zinc cost. We have seen an increase there again of around 16 cents. That is attributable to the slight decrease in production, which Nigel spoke about earlier. 5 cents of which is cost inflation, again, around consumables and reagents. If you think about it, we consume things like steel in the ball mills and copper in the flotation plant as a reagent. So all of that commodity complex, increase of prices filtering through to miners right now. And also the way we calculate the zinc equivalents with the relative price moves in lead and zinc, plus the production increase relatively of zinc and lead. We are apportioning more cost towards that zinc than we did in the previous period, hence the higher C1 cash cost. But if you look at the actual unit costs on site, those are almost entirely down to inflationary pressures. A lot of that is actually foreign exchange at Sasa, where we've seen the Macedonian denar, which is pegged to the euro, appreciate relative to the dollar, and 41% of our on-site costs are related to foreign exchange increases. We go to slide 9, balance sheet. As Nigel said, we continue to delever and more aggressively with the additional prepayment that we announced this morning. I'll only draw your attention to a couple of items which may stand out on the balance sheet. One is your PPE number, which has decreased fairly significantly. There's 2 reasons for that. The primary one, again, is foreign exchange, where the local balance sheet in Macedonian denars is impacted by the relative weakening of the dollar there. Plus, also, we've started depreciating our latest tailings facility, and this is the first full period that we'll be reporting the depreciation of that facility. If we go down the table to other liabilities, that unrealized hedge loss of $4.9 million needs a balancing item somewhere in the accounts, and that's where it sits right now within that 22.4 million, hence the higher increase there. Slide 10, please. This relates to CapEx. Now, if you recall from our previous announcements, we have been talking about a project to transition from the current sub-level caving mining method to cut and fill. And we started to see some of that CapEx come through in H1 this year. $3.3 million of the total CapEx spent on a cash basis is relating to that project, alongside $2.9 million of sustaining CapEx at Sasa and $1.5 million of sustaining CapEx at Kounrad. Now, the sustaining CapEx relates to replacement of some mining fleet, mine development underground, and also the usual dripper pipes and implementation of what we call the ILS system, intermediate leach solution system, on the eastern and western dumps at Kounrad. Cut and fill, and you can see the little photograph there of some of the items that we've bought. That's a new twin boom jumbo, which is going to be excavating a decline. So it's that sort of thing that we're buying, so decline equipment. And we've also received certain items related to the paste fill plant that we are constructing, and also some prepayments that we've made on equipment relating to that cut and fill project as well. Final slide from me, slide 11. Cash flow, and this is important because it does drive that dividend. We're very pleased to report that enormous increase in free cash flow period on period to $48.9 million. Again, if you look at the sort of development of that from the cash balance at the 1st of January this year, we generated $60.9 million of cash from operations. We have, in terms of investment and returns to shareholders, purchase of equipment, $7.7 million, repayment of borrowings, $19.2 million, dividends of $19.4 million, all value generated for shareholders there, and then some other items, including income tax, interest, and some adjustment on our working capital facilities as well. So ending the period with a very healthy cash balance of $54.3 million. On that note, I'll hand back to Nigel.
Thanks, Gavin. Hopefully you can see there a strong financial performance, strong balance sheet, and some good returns back to shareholders, as well as early repayment of the debt. Just a few slides now on our progress in improving our sustainability and our ESG credentials. Health and safety, first of all. Slide 13, if you don't mind. At Sasa, we have disappointingly had 3 LTIs in the first 6 months of this year. We're working to understand what went wrong and improve the procedures on site there. And at Kounrad, we've had no LTI. So overall, at group level, we're reporting 3 for the period. As I said before, that gives us an LTIFR, which we measure ourselves against, of 2.5 for the 6-month period. COVID, we have had cases of COVID on site, 77 at Sasa and 58. These are cumulative numbers at Kounrad. Currently, we have no cases at Kounrad, and we have, I think it's 3 or 4 people now currently with COVID-19 on site. But I think overall, as I said before, I think we are controlling that reasonably well. The vaccination programs, given quite a lot of government initiatives and government pressure effectively in Kounrad, we've got nearly 100% of our employees now double vaccinated, which is really encouraging in terms of moving forward with this pandemic. Slightly worse at Sasa, where I think it's 36% at the moment that we've had vaccinated. There's a little bit of resistance to vaccination within the country. That kind of percentage vaccinated mirrors what the general population is. So we are trying as best we can through a program of education to try and educate people about the benefits of being vaccinated. And slowly but surely the government are clamping down on things that you can't do without a vaccination. So I think that's helping us on site as well. But that's work in progress a little bit. Moving on to a more broader update on sustainability. We published our sustainability report, our second one to GRI standards in April this year. That incorporates 4 of the 17 United Nations Sustainable Development Goals. So no poverty, good health and well-being of all our staff, quality education, decent work and economic growth. So I think all the work that we're doing on there is pushing us forward in terms of how we report on sustainability matters, and we're quite proud of where we've got to for the size of company that we are. At both operations, both Sasa and Kounrad, we now have an independent legal entity that we call a foundation, which does charitable works for the community. We put money into those separate legal entities, and all that money is ring-fenced for community projects to improve education, welfare, and just move things forward from a sustainability point of view. The outlook, we continue to work on our climate change strategy, as I mentioned before. We're looking to come out later this year or early next year with some greenhouse gas emissions target. We've made a good start with this 35% reduction at group level from the renewable energy at Sasa, but we're also working on solar farm at Kounrad and other initiatives, tree planting, etc. at Kounrad and Sasa, and we'll come out with more details on that later in the year. A couple of other points: asset retirement obligation, which is something any mature and responsible company will do. For closure responsibilities, what's expected of us. We've engaged with a company called Golders to actually do some work on that, and we'll be reporting on that later in the year as to what our plans are in that regard. And the last one is the global industry tailing standards, which we're making good progress in terms of compliance with that on the suggested 3-year guideline from August of last year. We're quite well advanced on that in terms of meeting the compliance against that particular standard. If you turn to slide 15, I won't talk much to this, but just to re-emphasize the point that we are setting targets for sustainability, and against those targets, executive remuneration will be benchmarked. So we will be set targets, and rewards and remuneration will be against how we perform against those targets. So, for example, in governance, we're looking this year for 0 human rights abuses. Health and safety, ones that we've always set ourselves, really 0 fatalities and improvements in LTIFR. People targets in terms of collective agreements at Sasa, and also developing plans to train and develop and improve the knowledge and of the workforce at Sasa and at Kounrad. Environment, 0 severe or major environmental incidents is a target for this year. Unfortunately, we, as everybody on the call probably knows, we did fail on that one with our TSF4 incident last year, almost a year ago to the date, but I think we've recovered from that, and I'll touch on that a little bit later. And finally, on the community, just working closely with the community, really, and putting money into the community to develop it and be a responsible citizen. Just a little bit more on the greenhouse gas emissions. You can see the chart there on slide 16. We did manage to reduce our CO2 footprint because we use less coal at Kounrad primarily between 2019 and 2020. So we're now reporting for 2020 about 98,000 tonnes of CO2. As I said before, the 35% reduction in that number on an annual basis from this renewable energy supply that we've negotiated at Sasa. Just a few facts and figures of our electricity consumption at both sites, and I won't re-emphasise the point about the 35% reduction, because I think I've probably said that enough. In terms of slide 17, just a little bit on where we spent money within the communities. And the picture on slide 18, which I'll come to in a minute, is where we've primarily spent our money at Sasa. But at Kounrad, we have purchased an ambulance to help out with not just the pandemic, but moving forward with all kinds of health issues in the local town of Balkash, near to us. And we're constantly putting money into the community there to help out. So just moving to slide 18, there's a few pictures there really, not a lot of words, just a lot of pictures of something which we spent just north of $100,000 on as a kind of goodwill gesture back to the community in Kamenitsa following the TSF4 incident. Something I think as a management team we're particularly proud of. And I was there on site last week actually, and there was a lot of young children, a lot of parents using the facility. It was a lovely sunny day, and it was really nice to see that we've actually built that and given that back to the community. And I think the Mayor is particularly grateful for that as an input. And just turning over to slide 19 now, and really to draw a line on the TSF4 incident, which has taken us a while to recover from. I think hopefully we've managed it in a very professional and transparent manner. Obviously, there was the immediate remediation of the dam. There was the getting back into production, some slight changes to our operating procedures there to improve things. And we had an audit from Knight Peasold in late June, early July, which gave us a very good complimentary review independently of how we're managing that facility now, which is very pleasing for myself and Gavin to get that. But there's just a few pictures there of something which has taken slightly longer to remediate, which is the pollution that we very unfortunately did to the river. We stated at the previous announcements that 95% of the tailings have been removed from the river by the end of December 2020. In this half that we're reporting now, we have continued that work, and the river is actually in a very good condition, helped by Mother Nature as well a little bit with some strong rains that we've had over the period that have flushed things through. But we've now removed all the silt traps. We've planted 3,600 trees, 350 shrubs and 320 kilograms of wildflower seeds and grasses to try and improve the environment there. So again, that's drawing a line under the TSF4 incident in terms of the community park, the river remediation and the work that we've done on site to improve our procedures to prevent this happening. So if we just move on to an operational update and move to slide 21, very quickly, everybody knows the Kounrad operation, I'm sure. We're now reporting approximately, because as we know, this is not an exact science in many ways, that we have about 134,000 tons of recoverable copper, still to produce at Kounrad. About 10,000 tons on the eastern dumps and about 124,000 tons on the western dumps. Slide 22 is just a diagram, standard one that we put every 6 months up to the investors of our production. Everybody knows it is seasonal. We produce more in the summer months, and the standard leach curve there in the bottom, and we are progressing well on all of our cells that are currently operating in terms of the production. Moving over to slide 23 now, something which Gavin mentioned before, which is some capital work that we're doing at Kounrad to help through to the end of life of mine in 2034 is what we call an intermediate leach system. That's phase one has been completed. That was the construction of a 14-kilometre water pipeline from the east to the west and the associated pumps. Phase two will be completed next year with the irrigation pipeline onto the older western cells that we'll be irrigating to get some extra pickup. And then phase three will effectively be operating in 2023 during the summer months to increase the offtake from those western dumps and increase and maintain the production levels. There's a table there at the bottom of production, and just to re-emphasise, for the first half of this year, we produced 6,214 tonnes of cathode copper, and we're on track for the upper end of our guidance at 12,500 to 13,500 tonnes of copper. Slide 24, just moving on to the Sasa zinc and lead mine. We've now owned this operation for almost 4 years, and just a few statistics from it. We've now generated $214 million of EBITDA from it, so it is a highly profitable operation. We've repaid $135 million ahead of the announcement this morning for the early repayment of another $10 million off that debt repayment. We have reserves and resources out to 2037, and as everybody knows, it's a mechanised underground mine. The production numbers there, slide 25. There's a table on the right-hand side just showing the first half of this year. We mined 414,000 tonnes of ore. We processed slightly more, 423,000 tonnes of ore. We had some on stockpiles at the surface at the beginning of the year. We have had a few issues with some of the grade issues as we were a bit behind on development, and we generally get higher levels of dilution when we're getting production from the stopes and the stopes, and we suffered that a little bit in the first half of this year. We are recovering from that. We've had some couple of good months, and we are maintaining as a consequence of that recovery program our guidance for the year of 23 to 25,000 tonnes of zinc and 30 to 32,000 tonnes of lead. And just to re-emphasise, what we've actually done at the half year was nearly 11,300 tonnes of zinc and 13,800 tonnes of lead. But just to mention those points about the grade, and we have a programme to try and recover some of those grades by doing more production from the development stopes as opposed to the stoping from the development channels as opposed to the ore stopes. So that's Sasa production. Big project at Sasa on slide 26. I won't talk much to that slide because it's just a picture of the portal for the new decline, which we've started. So if you move over to slide 27, we've now named this new decline the Central Decline. In Macedonian, that's Niskop Central, for those who might be interested. Development has commenced. We've got a good team on site led by Phil Jackson and Tommy Purcell, who are managing that and training the guys in the new equipment that we've bought to manage that new decline. We've done so far approximately 200 metres. We took the decision to start the decline from the 910 level, so start underground effectively, where we've done now 188 metres. And the picture you just saw a minute ago, which was the opening portal, we've now excavated in about approximately 10 to 12 metres from that surface. And we're just getting to the point where we should hit hard rock and then start heading down to meet the 910 level. We expect to do about 800 metres of new decline this year, and it is a 3 to 4 year programme to do 3.8 kilometres in total. And why are we doing it? Well, it's going to give increased ventilation and improve the ventilation. It'll make far easier access into some of the lower areas of the mine, and it would be effectively increase our ability to ultimately increase production up to 900,000 tonnes with greater access to the lower ore bodies. So that's the Central Decline. There's a long section on slide 28, I think it is, which shows the mine. Again, won't talk to that. You can see the dashed line there just showing where that new decline is heading from the surface, from nearby the process plant down to the 910 level and subsequently down to below 750 level on a 3 to 4 year programme. Slide 29. The paste backfill plant, which is a key part of this programme, is well advanced in terms of design and choice of suppliers for most of the equipment. The equipment laydown area on site has been established for when those supplies are delivered. The new site offices have been delivered to site and will be marking out and segregating the area shortly. And as I say, most of the major plant components have been ordered and over the next few months will be delivered to site ahead of construction starting in the first half of next year. And we're on track to install the reticulation start installing the reticulation, which is basically the plumbing and the pipe work that takes the paste from the backfill plant to the voids and the areas within the mine that will be putting that paste. We're on track to start that pipe work in October of this year. And as I say, on track in total for construction of the paste backfill plant and the reticulation to be done by Q4 2022, and then it'll go into operation shortly thereafter to transition into cut and fill mining. Probably the more difficult aspect of the project in some ways is dry stack tailings. We did have a while where we weren't 100% sure where we were going to place those tailings. Knight Piésold have done a conceptual study, giving us confidence that we can place between 3.7 to 4.4 million tonnes in the older area of TSF2. So we are now going to detailed engineering design, and we're expecting a report back from Knight Piésold at the end of October on the detailed costings and design of the dry stack tailings landform, as we call it. The plant itself, which is a basic filtration plant to get the moisture levels down to 11.5%, is fairly well advanced with the team on site in terms of, as with the backfill plant, design, ordering of equipment, and that is also on track for finishing by Q4 of 2022. So that's slides 29 and slide 30. Just moving over now to jumping one really, slide 32, if everybody would please just look at that. Our capital allocation priorities, just to reiterate, this morning obviously 8p dividend, that's going to cost us about $19.5 million. But on top of that, we're paying $10 million back to the bank in advance of the regular payments that we make, which is $3.2 million every month. We maintain our policy of 30 to 50% free cash flow being paid back to shareholders. This particular dividend, as I said before, is 40% of that. And in total, since we started the dividend policy back in 2012, we've now paid back £1.20 to the shareholders $229 million in total. Something as a track record we're particularly proud of as a company. And as Gavin said, and I won't reiterate the point, we are deleveraging rapidly. And in theory, with this advance payment of $10 million, we would have paid the debt off by the 4th of August 2022. Just continuing with capital allocation, slide 33. Clearly, the other leg of that is not just paying back dividends and paying back to debt holders, but it's also investing in the business, developing the business. And I've already touched on the cut and fill project at Sasa, and we are spending between $18 to $19 million of capex by the end of 22 at site to deliver on that. What will it give us? It gives a more efficient method of mining, maximise the extraction of our mineral resources, so more metal for the ore that we're actually mining, and it'll certainly improve the tailing storage in a more environmentally friendly way as we put 40 to 45% that kind of level of tailings back into the voids underground. And it will be a lower capex than building another 2 TSF4s further down the valley, which has its problems and complications if we were to have had to go down that path. But this is a solution to that. And finally, on capital allocation, we're looking at growth opportunities. We continue to look. It is opportunistic. We've looked at about 18 opportunities over the past 6 months, and various NDAs signed and site visits, but there's nothing much further than that at the moment. But clearly, it's something we wish to do to actually enhance our portfolio of assets within the group. So just finishing off on slide 34, just on the outlook. I think we've announced some strong financial numbers this morning. We have got a good, strong, sustainable business with strong finances and good performance on the sustainability aspects. Strong operational performances, a few challenges in the first half of this year that we're working hard to overcome. And our basic mantra is to produce the basic metals that we need, that are essential for modern day living in terms of what society needs to actually move forward. Strong EBITDA and free cash flow generation, a good dividend back to shareholders this morning announced of 8 pence and $10 million back to the banks. And our outlook is really to continue on delivering to our shareholders the production, work on our climate change strategy, which is work in progress and will deliver either later this year or early next year. Delighted with the reduction that we've so far managed to achieve on the CO2 footprint of 35%. And strong metal price environment is obviously a very favourable tailwind for us, and long may that last in terms of maintaining good financial performance for the group. And on that note, I'll hand back to the operator, Emma, and we'll open it up to any questions.
Thank you. If you would like to ask a question, you can do so now by pressing star 1 on your telephones. That's star 1 if you'd like to ask a question. We will now take our first question from Alexander Pearce from BMO. Please go ahead. The line is open.
Great. So morning, both. So it's really good to see, obviously, the move to renewable energy at Sasa. I just wondered, could you give us any kind of indication of the cost impact of that going forward? And then also, obviously, moving to cut and fill, I wondered if you can kind of give us an idea of how much of an impact to your overall energy consumption as well for the mine.
Dealing with the first question, Alex, and good morning to you. Yeah, there's not a major premium. We've been using EVN, who's the supplier of our electricity, for some time now, and it is quite complicated, the supply of electricity in Macedonia, which is why we're really only claiming 94%, because they have put in place, in discussions with us, a process whereby they'll audit that and give us declarations of origin to prove that it is renewable energy from a company called EVN Electronic, which is a sister company of theirs, and is 100% renewable energy. In terms of the costs associated with it, we paid a slight premium for renewable energy, but electricity costs in general have increased at both of our operations, and particularly at Sasa, where they've gone up from like 6.5 cents, I think it was, per kilowatt hour, closer to 10 cents per kilowatt hour. So, across the world, people are experiencing an increase in electricity costs because of these issues. So how much of that is factored into it, I certainly don't know, but we paid a small premium above and beyond that price just to ensure that we got renewable energy from them with as I say, a certified process underlying it. In terms of our increased CO2 footprint because of the cut and fill, probably during the construction period, you're right to say that will happen, but I think it's probably a number of moving parts for us to assess what the actual footprint will be once we move into cut and fill, because obviously we've got a different operation then with different movements from how the ore is moved underground and through the decline. And we are looking at using electric vehicles in the future, and that's why we've widened the actual decline itself and the original plan such that we can accommodate potentially in the future electric vehicles. So I think that will help. So there's quite a few aspects we're looking at Sasa and at Kounrad to bolster that initial starter pack, if you want to call it that, of 35% impact on our 2019 or CO2 footprint. Does that
okay, thanks. And then maybe if I ask, sorry. Hello? Sorry, can you still hear me?
Yeah, I can hear you, Alex. Sorry, yeah.
Okay, good. Sorry, yeah. Maybe I can just ask a kind of a follow-up just on Kounrad. Obviously, you haven't completed the feasibility study yet, but do you have a kind of a rough idea about how much power potentially could come from solar in terms of like a percentage of the total and you know how seasonal that could be?
Yeah, I think of the amount that we consume at Kounrad, we're looking at the solar farm will contribute, I think, 20 to 25% of that power. So it would be no more than that, really. It wouldn't be the full 100%. You know, as things improve in Kazakhstan, we will look at other opportunities there. But at the moment, that's where we're putting our focus as we move from scoping study to feasibility study. And we've, you know, allocated the area and we're dealing closely with people to actually get that delivered effectively.
Perfect. Thank you.
Thanks, Alex.
Thank you. We will now take our next question from Sam Catalana from Canaccord. Please go ahead. Your line is open.
Yeah, thanks. Good morning, guys. Two questions. Just firstly on unit costs in the second half. Obviously, you've already spoken a bit about some of the inflationary pressures that you dealt with in the first half. Just wondering how you're seeing that into the second half of the year. And then the second question, just to maybe push you a little bit more on capital allocation, which, to be fair, you've been very clear on. But I assume in the board discussions, you potentially could have gone to the top end of your payout range, 50%, and perhaps not paid as much back in debt. Just wondering how the decision process worked around balancing those two sort of competing uses of capital. Thanks.
Do you want to say that again?
Yeah, well, I'll take the first half. Certainly, in terms of unit costs, Sam, I think the electricity increase that Nigel mentioned earlier, we're going to see more impact from that in the second half at Sasa. We think that all the other costs are reasonably under control, and you're probably seeing what we presented today is probably going to continue into the second half. Anyway, we may see some additional G&A at Kounrad as well, relating to some salary increases there, just as the sort of inflationary pressures hit. But other than that, not so much. On the positive side of things, as I mentioned earlier, we've got our treatment charge contracts kicked in on 1st of April, so second half TCs will be lower than H1 TCs, and that we've reported earlier, we're looking at about a 30% decrease, annually on those treatment charges. So that's a good positive there.
Mm-hmm. Yeah, and I think Sam, on the capital allocation, hopefully we covered it reasonably well. It's a fair question you ask. How did we arrive at that decision? I mean, it's one of these situations you can never please all the people all the time, can you? So we have different shareholder bases, and what we thought was a good balance was to pay a healthy dividend. As also, we've got some shareholders who would prefer us to pay the debt off maybe earlier. So we thought, because of the strong, cash flow generation we've experienced because of the high commodity price, it seemed a good balance to pay back early without any penalty some of the debt, really. And I think that strikes the right balance. And we didn't want to get ahead of ourselves too much, because it would maybe then create a problem for the final dividend where people expect it almost. So I think it's a good balance, really. And we have historically paid around the 40% mark. And I think 8 pence and $10 million back to shareholders just strikes that balance from a capital allocation side correctly.
Yep, no, that's very clear. Thanks, guys.
Thank you, Sam.
Thank you. We will now take our next question from Richard Hatch from Berenberg. Please go ahead. The line is open.
Yeah, thanks a lot. Morning, Nigel and Gavin and team. A few questions. First one is just on the move to the Western Dumps.
Yeah.
Are you comfortable on the recoverability there? I mean, you kind of talked to the challenges that you saw. You managed to mitigate it in this sort of first year of going wholly there, and this winter you'll kind of blend between the Eastern and the Western. But Are you comfortable that you're able to get the recoverabilities that you're looking for? And is there going to be any impact on costs as a result of that if you need to sort of throw a bit more reagent at it or such like?
Yeah. No, I mean, on the cost side, first of all, Richard, and good morning to you, we don't expect a major incremental increase in costs as a consequence of doing any of this, really. And am I confident in the recoveries? Well, we've now been leaching the Western dump since 2017. And yes, we are confident, and we claim 35 to 42%, which is quite a range for different cells. And we're confident that we will get that recovery over the life of mine out to 2034. But clearly, because it is lower and it's a longer leach time and everything else, we have to husband those cells, and that's all we're trying to do here by trying to get an extra little bit of pickup from what effectively is acid rock drainage, isn't it? In fact, because it's fresh water we're putting on, and that's what we will do. You get a little bit of copper back because there's enough pyrite and pyrrhotite in the cells to generate their own acid. If we have to add some acid to it, we will do, but we don't suspect at the moment from what we've experienced in the West that we need to do that, and then we'll put it onto the other dumps just to increase the tenor of the grade and just to help with the production side of it. So not a major increase in cost. Confident with the operation on the West, having done it now for 3.5 years, and the kind of recoveries that we're getting on our program to rotate around those Western cells to get the 124,000 tons that we require. We may end up, as we often say, it's not an exact science. We may end up recovering more than that, but our plans are based on those numbers and those recovery levels, and we're fairly confident that we can do it. Howard and the technical team there had planned this ILS system quite some time ago, actually, and we don't need it at the moment, but we feel it'll be a good beneficial supplement, if you like, to the operation in the future at pretty minimal capex cost, to be quite honest with you. One thing just to add on to it, which we did experience during the winter of last year, was we stopped for the first time since we started operating. We stopped the eastern dumps and just leached the western dumps. And that did create a few concerns over the consumption of reagents. That came through some of the costs. And at first it was flummoxing. Even people like Howard and the rest of the technical team were pretty knowledgeable about these things. And we concluded there was either a physical leak, which we then concluded there wasn't because we inspected all the equipment. And we looked at viscosity levels and the different makeup between the east and the west. And so as a consequence of that experience last winter, what we've decided to do is continue leaching the eastern dumps throughout the winter period this winter. And I think that will help as well with the kind of makeup. So as with many things in life, Richard, you live and learn as you're going through it, but I think we're fairly confident how we manage and husband those dumps through to the end of their life.
Thanks, Nigel. That's very helpful. Can I switch over to Sasa? So you talked a bit earlier in the presentation about the dilution challenges that you were seeing there. Would you just be able to kind of give us a bit of a flavour as to how you've seen sort of the mine perform in the last couple of months since you provided that last update? Is it kind of more tracking in line with your expectations, and are you managing to kind of show some signs of improvement and get a handle and sort of address those challenges that you saw?
Yeah, Scott and the team on site have put in place. We fell behind on development, is the honest answer, and we have got some, poorer ground conditions down at 910 and 990 level, which takes a bit of work. So they put in place a recovery program. So we are seeing more of the ore coming from the development as opposed to the stoping, which is development generally has got lower dilution, as I said before, because you're more in the core of the ore body. So this recovery program is showing signs in July and August. We've had a couple of good months, I have to say, which is positive. But I don't want to sit here and be disingenuous and say, well, definitely we'll get back to the lower end. That's what we keep maintaining guidance at, but we may be a couple of percentage short, and likewise we may be a couple of percentage over on the copper, as I said before. But we have a plan in place and we're working hard to deliver on that, and the past 2 months have shown signs of recovery from that with increased combined grades on daily basis for quite a number of days above 7%. So that's all positive as far as we can see.
Yeah. Okay. Cool. And then while we're still at Sasa, just I noticed in the results that there's some kind of commentary around technical work to look at the move to 900,000 tons a year, third ball mill, and maybe some additional float cells. I mean, have you got a kind of rough sort of order of magnitude on what kind of capex that might be?
Well, we've got the order of magnitude on the main backfill plant and everything else. I think we've put around 2 or 3 million for the plant. If you're talking specifically, Richard, about the plant expansion, that's the kind of number.
No, there's the ball mill, third ball mill.
That's the kind of number we're talking about, $2 to $3 million on the ball mill for the plant expansion. It will be a few more flotation cells, a bit of an expansion maybe to the building itself, and then a ball mill is what Barry O'Connell, who's running it, is thinking about at the moment.
Okay, understood. Sorry, I'm nearly done. Just on the labour renegotiations at SASA, have you got a steer on what kind of inflation rate that kind of is a good order of sort of magnitude to think about?
The actual official inflation, I think, is about 3.5% in Macedonia at the moment, something of that magnitude. We are going through, and we will go through a collective bargaining agreement, which we expect to finish in this half of the year. So I can't really say what percentage pay rise we may give next year. In terms of that will be pretty confidential information, I suppose. So no, I can't. But as I say, and as Gavin alluded to, we are, as most mining companies and people across the world, experiencing some cost inflation as a consequence of high oil prices and metal prices. We're not immune to any of that. But I think the numbers are probably sub 10% overall, even though they look on the face of it higher than that. If you strip out exchange and you strip out mineral extraction tax and those kind of things, we're probably looking at percentages in some consumables and some aspects that might be 10% and some that are less. So, anything below the 10%, I suppose, is what we're looking at as a kind of cost inflation overall that we're experiencing across the patch.
Yeah, okay. And then just on the M&A commentary, would you be able to give any more sort of, are you looking across the piece in terms of development assets, or is it producing, or is there any? Could you just give a little bit more flavour as to kind of some of the broader kind of opportunities you're looking at? Should we be expecting maybe a producing mine or something that you can just step in and finish the development of?
There's not a lot more I can add, if I'm honest with you, Richard, and I always feel I give a woolly answer on this, so I do apologise, but it is opportunistic, and we are increasing our focus on it and our energy on it, really, to see what we can pick up on top of our current assets, which is a great base to build from. And it could be something in production. I mean, ideally, it would be something in our own area, be it the Balkans or Central Asia in copper. It is primary, but beggars can't be choosers sometimes, so we have to look at other assets and be a bit more creative and look at the opportunities and look at every aspect of it. So we continue to do that. I think we're looking at having paid all our debt off next year at some stage, and certainly turning into a net cash position soon. So we've become stronger by the day to actually acquire a decent asset, but it is opportunistic still in terms of where we look.
I mean, it sounds obvious, but the key thing is the accretion metrics that we look at here. So, Richard, of the 18 that we reviewed, over the last 6-7 months or so, they would have included producing assets, development assets, and a larger sort of transformational
M&A.
Okay, thank you very much for taking my questions.
But apologies.
Thank you. We will now take our next question from Peter Mallon-Jones from Peel Hunt. Please go ahead.
Hi guys. Unfortunately, Hatchie jumped in with my M&A question, so I will defer to the next questioner, please.
Oh, sorry about that, Pete.
As a reminder, if you would like to ask a question, you can do so now by pressing *1 on your telephone. We will now take a follow-up question from Richard Hatch from Berenberg. Please go ahead. The line is open.
And thanks. Sorry, I have got a last one. I just with the Traxys agreements kind of coming to a conclusion at the tail end of next year, how are you thinking about the sale of the products from Sasa and Kounrad when you haven't got to sell it into Traxys? Would you kind of extend? Are you happy with that, or do you think that you could get potentially a better agreement somewhere else?
Well, Richard, I think on Kounrad we have been selling to Traxys since the outset there, but we have during that period run at least one tender process where we've invited other parties to tender for the material, and there's no obligation to stick with Traxys beyond October 22 on Kounrad. So, I foresee us running a similar process again. On the lead zinc side, it's the products are far more complicated. The logistics are way more complicated as well. So, I don't see us, doing that ourselves, but, we haven't decided anything yet in terms of running tender processes and the like, but I think there's certainly, benefit to having somebody with that deep market knowledge assisting us with those sort of sales.
Thanks, Gavin. Cheers.
Any other
Thank
questions?
you. There are no further questions in the queue at this time. I will turn the call back to your host.
Okay, well, thank you very much for everybody attending this morning. Thank you to Louise for producing a lot of the literature for it, and thanks to Gavin. And thanks to the board for supporting us on announcing a very healthy dividend of 8 pence and $10 million back to shareholders. We will work to improve our climate change strategy, or develop our climate change strategy, as we've already announced. Work to improve on the production in the second half from the first half, and deliver on that guidance for the year, and continue to pay down our debt and look for other business opportunities. But I'd like to thank everybody for paying attention this morning and listening to us, and we look forward to meeting some of you, hopefully in person, physically, in the near future, as we move, hopefully, out of the COVID-19 restrictions we've all suffered from for the past 18 months or so. So thank you very much, and goodbye.